Bloomberg's Lizzy is with us to discuss. Lizzy, what does this mean then for the Bank of England? A slightly softer print in terms of CPI.
Slightly softer, yes, Tom. 3.1% in September. This was the last reading before the Bank of England's November meeting when, as we know, markets are expecting the bank to increase interest rates for the first time since the pandemic crisis to 0.25%. This figure will buttress that assumption. The rise was driven by a rise in transport costs, fuel costs up, second-hand car prices up, but you also had a fall in restaurant and hospitality prices. That's after last year, if you remember, when restaurants and hotels increased prices at the end of the Eat Out to Help Out scheme. But the bottom line is, each month the inflation spike continues. It makes the narrative that it's only transitory look shaky. And that's a problem for British households because, as the Resolution Foundation warns, it's going to weigh on household incomes at a time when the government is raising taxes and cutting benefits.
So, Lizzy, what does this mean for the budget?
Well, retail price inflation is also up. It grew by the fastest pace since 2011, and that causes a headache for Chancellor Rishi Sunak because it helps determine interest payments on gilts. So what we're hearing is that the Treasury is under pressure not to unleash an expansionary budget on the 27th of October because the inflationary pressure of that government spending could encourage the Bank of England to hike interest rates more aggressively, and in turn that would drive up the cost of servicing the government's debt burden. It's interesting because we haven't had this tension between monetary and fiscal policy in such a long time. So we're hearing that the plan is that Rishi Sunak will rein in the public finances now and unleash closer to the next election.
OK, our UK reporter Lizzy previewing that all-important budget out of the UK and the implications of a slightly softer CPI print.